Okay, time for another weekly Q&A. I missed it last week. There was just a lot going on with earnings last week, and I was engaged in a lot. So I just thought, oh well, I can miss a week. I've earned that right, I think. And it's Tuesday night, November 4th. I am up at 4 a.m. tomorrow morning because I'll be driving up to North Bay, or for my northern friends, North Bay. There's no TH on the end, it's just Nort. Looking at some bear pelts. Beer pelts. There's my youth coming back, eh? Bear pelts and wolf pelts. I don't know that I'm going to like any of them because I think the best pelts to get are the fall pelts, which are really only ready in January or February, but we'll have a look. So I'm doing this on a Tuesday night. You usually generate returns by selling options and CSP to capture theta and IV. But what should one can do if they can't fully cash back their short option positions? Spreads are one thing, sure. Or find another lower risk strategy. Make sure that you have your contribution plan in place so that you can get to a point where you can back it. I usually say that if you can't afford the risk that you've taken on, don't do it. But spreads can do it. Spreads are lower return but much lower risk and much lower capital required. So the return on the investment is a little bit higher. Why would you say Fed has a horrible record on forecasting? Well, that's empirically driven, right? Is you can take all of their summary of economic projections for the last 4 or 5 years. You could look at what they forecasted on a particular date, and then you could just look forward to see if any of that actually happened. And they have some of the worst track record of being right. Most of their forecasts are just linear forecasts of whatever's going on. And they are mostly wrong. So it is just empirically driven. I thought they were in the best position in terms of forecasting key monetary fundamental indicators. You would think that they would be, but they don't have access to any particular data that you don't have access to. Thought the majority of the market would look at Fed as a credible central bank. They do. There's a difference between being a credible central bank in terms of conducting monetary policy and being right on your forecasts or having a good track record on your forecasts. Investment banks care about this stuff because if they were always wrong, no one would listen to them after a while. Fed officials aren't on the sell side of anything. They don't give a shit. I thought the majority of the market look at it as a credible central bank, but they would act on the changes in monetary policy premises and expectations. Well, they do, based on whatever the data tells them. But listen, the future, it's not that it's unknown. It is unknowable. There is a difference between that. So if you ask me about a particular chemical reaction in the body, I would say I don't know. To me, it is unknown. That does not mean that I cannot know it. To say something is unknowable means nobody knows. Nobody knows. And the future is not unknown in the sense that I don't know it but somebody does, or that it's capable of being known. It is unknowable. So everyone is just guessing about the future based on what they see in front of them that day. Some people get closer to the mark and are more consistent. Others are not. The Fed is one of those that are not. If you go back and look at all their SCPs, somebody's telling you there. On a recent live feed, you discussed how you determine your put strike price based on the price of the straddle. Using an example of a stock at 50, straddle at 10, how do you determine the price of the straddle? Well, what is a straddle? A straddle is a call and a put. So if we have a strike price here, let's say that this is the price of the stock, that's S0, that would be your strike price. It is a call and a put. And of course, the wings of the straddle, the break-evens, are the call plus the put. So it'd be the stock price minus the call and the put, and here's the stock price plus the call plus the put. Right, and those are the wings, and here's the put. And if it's something that I do want to own, and it has a good record of fundamental performance, I would sell a put over here. The reason is if I draw out implied volatility, and I draw out historical volatility, implied volatility usually overestimates historical volatility. But before earnings, what happens is implied volatility really widens out. So if you add up the call and the put, you get the implied move that the market is pricing in terms of what it is expecting, and you would go to the very next option that's expiring for the most part. Some companies really don't, like a utility, you wouldn't expect to see a spike in implied volatility before earnings. So if implied volatility overstates historical volatility and the implied volatility widens in front of a key risk event, it tends to almost always overstate historical earnings. And the empirical observation is that very few companies beat their straddle. Most, when they move, they'll go up or down, but they usually stay within their straddle. 85-90% of companies fail to beat their straddle. So if you are selective with companies and you just choose earnings volatility and companies that you do want to own anyways, you can do fairly well. What's happening with duration and ZQ? Who the hell knows? I have no idea. The market talks itself out of every rate hike. It talks itself out of every lower yield. It just says, no. That doesn't make sense to me to get something safe at 10-year at 4% when I can buy the market at 23 times forward earnings. Overvalued and pricing in perfection, I'll take that. The market has a way of talking itself out of red ink in equity and talking itself out of green ink in bonds. Why? I have no idea. Why do you put your main assets under Morgan Stanley management and not buy and hold SPY in your IBKR account? Well, diversification of strategy. I mean, I could do that. I could simply just buy SPY and say thank you, goodbye. Believe me, there are days I do debate that if I just put 60-40, I wouldn't do 60-40, by the way. I'd probably do 40% SPY. I'd do 20% IWM. I'd probably do 30% TLT, and I'd probably do 10% cash, because cash has a good return right now. Yes, 10% in cash. I'd probably do something like this. And these have very low fees. With Morgan Stanley, you are paying a sponsor fee. You might be 70 to 90 basis points. And then they put you in funds, which might be anywhere from, and their active funds might be anywhere from 40 to 70 basis points themselves. So yeah, believe me, I do question this as to why I do this. But there are other intrinsic benefits that I get. So for now, it will sit where it is for now. But at some point, I'd say 2 to 3 years in the future, I won't need the intrinsic benefits this offers me, and that will all reverse. But at some point, I'll repatriate and do that, yeah. Regarding MP, how do you categorize the stock buy, sell, hold? Well, you got to categorize it first as behavioral or fundamental. It is primarily behavioral in its actions. It has some fundamentals in there, but it has a long way to go to catch up with its valuation. That doesn't mean that it can't. It's a serious company with serious management. This is not some fly-by-night company. It's a serious company with serious management, with serious plans in what I think is a good space to be in for the future. But it is, in the end, a mining company and a manufacturing company. It's not a tech company. It should not trade at tech valuations. It should not trade like a meme stock. It is a materials and manufacturing company at the heart of it. even though it's in a different type of metal than most mining companies, it still is governed by the fundamentals of that. So I don't think it deserves the valuation it has, but for now it's behaving like a behavioral stock. So those are hard to short. You can get I think a good short position on these, but you do run the risk of headline after headline. In this company, if the management is as wise as I think they are in terms of the market, will produce the headlines necessary to keep that price up and to keep the retail crowd invested. They will keep producing headlines. So I don't know that this is a sell. This is a trading stock, by the way. This is not an investing stock. This is a pure trading stock. If you're thinking about a buy and hold for the next 10 years, I think you'll be disappointed. The fundamentals will grow into the valuation, but the valuation will be lower. And it will get there. So I don't know that it keeps this level for 10 years. It is a trading stock. Which makes, in my opinion, makes it a positive delta trading stock. Now, that's different than saying long or short, and that's different between saying buy and sell, buy, hold, or sell. It positive delta as a trading stock. How do you view the risk of a contagion in the private equity business development corporation space? Well, it really depends on, I mean, if there's $1 trillion of debt that goes bad, there's $1 trillion of value that's lost for some people. What makes it worse is if there's derivatives on top of that trillion, because then there's wealth transfer from this group of people to that group of people. And especially if there's derivatives on top of derivatives, right? Where it's hard to trace through exactly who's going to suffer. And if it blows up something important, right? If you decide to play soccer on a field full of landmines, well, that's your problem. But if the landmines are all over town, well, that's everybody's problem. I don't know where the landmines are. As I understand it, banks do not have a lot of exposure, but this is not a regulated space, so who knows? Part of the financial system would face stress if these deals go sour. Well, like I say, it would be the holders of the companies. And if there are no derivatives on these, then it ends there. That's as far as it goes. And certain groups of people, mostly accredited investors, would lose money, would take a hit. And it would have no contagion effect. That would be the best case scenario. The part on MP blew my mind, but I'm left with a lot of questions regarding the AM deal with OpenAI. If the capital raise allows AMD to book a ton of revenue that trickles down to EPS, allowing EPS to grow over time, what exactly would be the catalyst that makes the cycle come crashing down? Well, a share price crash would do it. Is it massive overbuilding of AI infrastructure that is met with sizable reductions in CapEx? Well, here's the thing. If my CapEx is coming out of your wallet, I don't really have much of a motivation to lower my CapEx. Only when my CapEx is coming out of my wallet do I care. But as long as it's coming out of your wallet, I don't really give a care. For OpenAI, their CapEx is coming out of AMD's investors' wallets, not their own. So what's to stop them? Even if somebody shows up the next day and says, there's a lot of overbuilding going on, so what? It's not my money. It's AMD's investors' money. It's not even my company. Who the hell cares? Right? So what stops it is, I guess, just a wider recognition and a narrative building that this all looks kind of like almost like a Ponzi scheme, right? That it's almost pyramid-y and Ponzi-ish, even though it doesn't quite fit, but it kind of smells like it. The next question talks about the accounting of this. And this is, it sort of gets to the heart of it, of how this is going to work. I'll try to do my best. I'm not an accountant, but I'll try to do my best based on what I've been able to read. A very interesting insight on the issuance of warrants to sort of fund revenues. I did some research that found that according to ASB, clarifies the accounting for share-based payments issued as a sales incentive to customers. So these aren't issued as a sales incentive to customers. At least this is not the way it was worded with MP materials. The warrants are part of a security issuance. For OpenAI, the warrants are issued as a just straight up issued that vest according to certain milestones that OpenAI meets, like deploying so many AMD chips in their facility. So it doesn't exactly say you must buy this quantity. It's worded as you must deploy this much. Now you may say, well, you're splitting hairs. It matters. Okay, so let me give you a balance sheet. And we have assets here, you have liabilities, and then you have equity down here, and assets equal liabilities plus equity. When you first record share-based compensation, you have additional paid-in capital, right? And you have capital stock. So the par value goes in here, and the additional paid-in capital goes in here. Well, you're either going to need an increase in a liability or an increase in an asset if you get that done. And this is where it turns. If it is tied to some kind of, let's say like AMD, tied to some, and same with MP, tied to some kind of time frame or performance, let's say a sale, for example, you will capitalize as an asset the full amount of whatever you put over here. So let's say that this came to, I'm going to make it up, 20 billion. You would put 20 billion over here. And the only way that you can do this is if the warrants that you issue are for your own shares. They have to be for your own shares, and no cash component to it. In other words, it is just for one share. Then you can avoid the liability. It gets listed as an asset. And here's your income statement now. And you're going to have revenues. And to get this out of here, you're going to credit this, and you're going to debit an expense to get this done. You're going to accrue this over to expenses as revenues are coming in. So you will have an expense. So when you get down to EBITDA, the expense will lower the revenue. So there's your EBITDA. And then, of course, you get down to EPS. So as the revenue comes in, you have an expense that offsets it. Therefore, you have a clean EBITDA and a clean EPS. So you think, well, how's it finding its way into equity? It already found its way into equity. So rather than finding its way into equity twice, it doesn't. Now you may say, wow, there's no effect on EBITDA and there's no effect on EPS. Well, do we pay attention to EBITDA and EPS? No, we pay attention to adjusted EBITDA. This is non-cash. To get from EBITDA to adjusted EBITDA, this will be added back on. Since this is non-cash, when you get to cash flow from operations, you have net income, you will add back this expense. So your cash flow from operations are going to be wicked, and your adjusted EBITDA and your adjusted EPS are going to be wicked. And EBITDA and EPS will be waved away as an accounting standard that you have to follow. It's that way because of accounting. They had to do it because of accounting. And you'll pay attention to adjusted EBITDA and to adjusted EPS and the cash flow from operations, and it's already in equity. So you have share issuance that shows up as revenue, that shows up as adjusted EBITDA and shows up as adjusted EPS and cash flow from operations. not cash flow from investing activities or cash flow from financing activities, which is what a share issuance would be, cash flow from financing. It shows up as cash flow from operations. Isn't that beautiful? Now, I think I have that right. I did spend some time on this, and I really pushed AI on this. I gave it a whole bunch of examples. Well, let's say I'm company XYZ and I did this, and you're investor ABC and you did this. Now you're not investor ABC, you're customer ABC. How would that change? And I did it over a couple, and when they all started telling the same story, I felt, okay, I think I got it. But again, let me caveat this by saying I am not an accountant. So I may not have this exactly right. So if there is an accountant out there, you can sort of nudge things in the right direction. Plug power is an example from Gemini. You picked the perfect, this is a Gemini output. You can read this. It sort of was the same thing. Here is how it happened. Plug Power explicitly stated that its accounts for the 2022 warrant, in accordance with ASC 606, revenue from contracts with customers, it classifies the warrants as consideration payable to a customer. The company measured the total fair value of the 16 million warrants at the grant date, and this total value is recorded on the balance sheet as contract asset. Yeah, so something shows up as an asset. And as you deliver hydrogen to Amazon and recognize revenue from those sales, it simultaneously amortizes a portion of that contract asset as a direct reduction to the revenue it just recognized. Look at the word amortize. EBITDA, before depreciation, amortization. Right? So you could just say, well, because I'm amortizing it is not an EBITDA. And if it is an EBITDA, I'll just adjust it out of EBITDA so that my adjusted EBITDA doesn't show it. Either way, it's not going to show it. But yeah, it shows up as an asset first, and then it gets amortized over time so that it doesn't show up in equity twice. It shows up in equity once, but that after you adjust your EBITDA and you adjust your EPS, you will find it. Just to argue on the French 10-year lower than U.S. ECB policy rates, approximately 200 basis lower than the U.S. federal funds rate. That is true. If we adjust for the 200 basis point difference in the central bank short-term policy, the remaining term premium, which includes compensation for both duration and credit risk embedded in the French 10-year yield, suggests that France is actually pricing in a higher credit risk premium relative to the U.S., consistent with its recent downgrade and fiscal instability. I don't know that I'd be comfortable adjusting it and looking at it in that particular way. You have different clientele effects altogether. I think the CDS market probably offers the better way to look at it. And then in the CDS market, you have to sort of look at what the historical spread between the French 10-year CDS and the US 10-year CDS would be. And I think it is reflecting the French 10-year CDS as being wider than the US 10-year CDS. So the CDS market is pricing in more risk into the French 10-year bond. What's your thoughts on the ABR sell-off? Is it an overreaction? I don't think so. When you look at the number of loan modifications, it's a little high. It's a little high. I don't like to see that. I mean, there's going to be some loans. You can't make perfect loans. You're not going to have a perfect loan book if you have an $11 billion loan book, but 18 loans is a little high. I'm short November $11 put on ABR. You always say that when somebody's in trouble, they should make their delta. Move your delta towards zero. What would you have done? Would you have done the same on ABR last Friday? Had I sold the put and it fell to $9 from 11? Well, there are two rules, right? Your rules sit at different parts of your process. You cannot just live by one rule. So you have let's just give a process line, and over here is inclusion into your portfolio. You decide that you're going to put something in your portfolio up here. You have a whole bunch of risk management that goes into deciding whether or not this is something you want to do. The first thing you would have done is you would have looked at the options chain, and you would have looked at the IV on the expiring contract, and you would have sold the put at the highest IV you possibly could have. Because, I mean, that's where we get our revenue from, is you want to sell something that is clearly overpriced, and higher IV means it's overpriced. You would have also looked at the liquidity of the options, and the wider the spread, the harder it is to get in and out of these things, right? And then you would have had your position sizing. You would have said, okay, my rule before I even put inclusion is no position big enough to hurt you. So how do I size this position? You take a worst case scenario. You say, well, okay, you have a base case, and your base case is that you're going to make money. Your best case is that it's going to really go up. Your base case is, well, I'll make money based on the IV crush, but maybe I don't make it all, but the next day I can close my options for a gain. Worst case scenario is it exceeds the straddle. Whatever the straddle is, you say, well, at 11 you were at the money, so you probably didn't have much risk management in there. But you just assume, well, let's assume that it really beats the straddle. It's going to move double the straddle. So if the straddle was pricing in $1, you say, okay, well, it's going to drop $2, so it's going to drop to $9. And you're selling the $11 put. Let's say you're selling one. That means you're going to be down $200 less whatever you got for the put. And let's say you got 50 cents for the put. So you're down $150 per contract. How do you size this? If you say, well, listen, no one position should take more than $1,000 away from me. This is if you have like a $100,000 portfolio. You don't want to lose more than $1,000 or $2,000 in any one position. You don't want any one stock to be 20 or 30%, represent 20 or 30% of your equity, because you'll blow up your book on one stock. That's what it means. No position big enough to hurt you. If you decide that, you know what, the most I can stand to lose on any one stock is $300, you figure worst case scenario is $9. That's I lose $150 per contract. I can do 2 contracts. And if it gets to $9, what is my plan? Before you even include it, you know what your plan is going to be. Your plan is going to be to move whatever delta you have. Since you're selling puts, you're going to have positive delta. You're going to move that delta towards 0, so you're going to need to add negative delta somewhere. Easiest way to add negative delta is to short the underlying. But before you short the underlying, before you even do any of that, you better check the SLB rates, because you don't want to short something that's suddenly costing you 12%, right? Because that's just even more losses right there. So you better check the SLB rate. You better make sure there are shares that you can borrow. The SLB is the loan borrow rate, the short loan borrow rate, that tells you how much you got to pay the person who lent you the shares on an annual basis, how much you pay annually, and you pay that, over the period of time that you're short. All of that would have happened before you even took the position. You would have went through all of that before you took the position. If I'm your managing director and you come to me and you say, here's what I'm going to do, right? I need to see that you've already sized your position for your maximum loss. You know what security you're using. You know when you're getting in. You know what price you're in trouble at. You know what your exit strategy is, and that's what you're going to execute. Then I say, you have a process. You have a process. Good. And you follow that process. You can be a very good stock picker, be 90% right, and have zero risk management ability, and you'll do okay. You can be an average stock picker, 50%, but you have wicked risk management, you're going to do great. You'll do better than this person over here. We are not asset managers. We are at all times risk managers, and a lot of your risk management has to come up front. You never walk into a room that only has one exit, right? You simply just stay away. You can look at something, say, well, I have a good idea about this, but I have no risk management ability in this thing. They're easier fights to win. You would have thought about all of this. You would have gone through all of this before you took that position. As Warren Buffett says, the best way to get out of trouble is to stay out of trouble. Your risk management up front will keep you out of a lot of troubling situations. Now, when I say that we are risk managers, is because if we want to make money, we have to take on risk. But it's risk that we understand, not risk we don't understand. It's risk that we can measure and risk we can understand so we know when to step in. If you focus on that, you will find your performance increases dramatically. This is a very difficult game to play if you're treating it like a casino. What should I buy? What should I sell? It is a much easier game to play if you treat it as a game of risk. What risks do I want? What risks do I want to avoid? How do I manage this risk once I have this risk? And less attention or less focus on what do I buy? What do I sell? How do I buy? How do I sell? That's the game. That's how the pros play it. Great update. One update or correction I think you forgot about is the increase in the salt cap. I don't even think I talked about the salt cap, but where would I have put it? A correction. Correction to what? I don't even think I was talking about that. Let's see. I want to touch on the topic of financial modeling with Excel in high finance. Ooh, you must be British. High finance. For years now, dynamic templates for valuations have been available, either company developed or third party. Yep, that's true. You can get financial models for any company you want, and then all you do is change your assumptions. Theoretically, can already do most of the grunt work in the model. However, teams in high finance like M&A already operate as slim as possible, 5 to 6 for most boutiques, because the managing director wants to split fees with a minimum amount of people. And the constraint doesn't seem to be modeling them out in Excel. Rather, it's seen more as a rite of passage to show that the interns and the analysts understand companies. Even with modern templating tools, MDs and VPs force their analysts to create models from scratch, even if not really required. Do you think that this is going to go away with AI? No, I don't think it's going to go away with AI. I think being able to demonstrate that you can look at a company and build it from the bottom up, I don't think that's going away. But the task of doing it on a repetitive basis, yeah, I think a lot of that will go to AI. You could say the same thing with programming. Is knowledge of programming language necessary anymore? Well, yes, it is. Because AI isn't always right, and you have to be able to read the output from AI and say, okay, yeah, that is exactly what I was looking for. It might take you 2 minutes to look at a function call. It might take you 10 minutes to write the function call. You just saved 8 minutes. But the knowledge of the language isn't going to go away. The knowledge of how to build your forecasts from the bottom up is not going to go away, but the legwork that you put in is probably going to go away. In my opinion, given that these teams do not seem to be constrained in modeling capacity, but rather amount of deal capacity, usually 2 to 3 per year per team. Ooh, it might be 2 or 3 deals, but the pitches, they do a hell of a lot more than 2 or 3 exercises. It's pitch deck after pitch deck after pitch deck after. You got to pitch. You probably got to pitch 50 companies to get one deal. There's a lot more than just 2 or 3. Function of relationships. But you get these relationships by developing the pitch deck and going and sitting in front of them so that sales can then say, here's what we think we can do. Here's an opportunity we think we see. I do not believe modeling in Excel will become obsolete in high finance. Modeling in Excel will not become obsolete. You modeling in, somebody sitting there modeling in Excel will become obsolete. Somebody assessing the output of AI doing it will not be obsolete. What do you expect the post-Powell Trump Fed to do regarding liquidity? Oh, it's going to increase its balance sheet. You're going to have quantitative easing, hands down. If the market is not going to give Besson to 3% 10-year, the Fed will. The Fed will buy. And if the Fed is buying these assets, it is increasing the amount of reserves, right? If it's increasing the amount of reserves, it's increasing the amount of liquidity. Still reducing the Fed balance sheet. They've already stopped reducing under Powell. They've already stopped reducing under Powell. Now, here is the deal. You are here. You want to get here. How you get there is important to you. As a person, you have certain lines that you will not cross. So if there are impediments along the way, there's a wall here, there's a wall here, there's a wall here, whatever these walls happen to be, these are your lines in the sand. These are things you're not willing to do. So you're going to have to find some pathway to get to where you want to go. Trump has no lines. There is no line he will not cross. He has, if you say, but that's not the way it's done, who cares? If you say that's illegal, he'll say, contact the Justice Department, find me a way. And even if it is illegal, he doesn't care. He has no lines that he's not willing to cross. You want a 10-year under 3%? Well, you can easily just increase the Fed balance sheet. Powell wouldn't do that. Trump doesn't give a shit. Increase it, buy. Put a shit to 10 trillion. But why stop at 3%? If 3% is good, 2% is better. Go to 20 trillion. Go to 30 trillion on the balance sheet. Why can't the Fed hold all of the debt of the U.S. and make the debt zero? I mean, if the Fed is going to return all the interest to the Treasury after, why even let anybody hold a security? There is no limit to what he wants. He wants this. And that's it. All means, for this guy, all means justify the end. There are no barriers. There are no lines in the sand. There is no behavior he will not display. There is no line he will not cross. There is no social norm that he will not break unless it serves his benefit. But he'll hold you to it. If you decide that you want something and all means justify the end, if it inconveniences him, he'll hold you to it. Oh my God, I can't believe you acted this way, but not him. So, he's anything that's available to him, he will use. He is right on one thing. He wins. He wins because he has no line he's unwilling to cross. Now, I want you to think about that. If you had a business and he had a business, and you had lines in the sand that you said, well, I'm just not willing to cross that line. I'm not willing to treat people this way. I'm not willing to act that way. He will beat you because he doesn't care. He'll do it. He'll do it. How do you win against somebody who has no line in the sand? You need somebody who also has no line in the sand. That's a tough game to win. I don't think that I'd want to play that game because I do have lines in the sand, things that I simply will not do. So I think that in trying to get a 10-year under 3%, I would rely on persuasion, on trying to find a win-win for everybody involved. That's not him, though. That's not him. Just increase the balance sheet. But what if it causes, who cares? Who cares? Who cares? Who cares? Just increase it. That's what's going to happen. That's what's going to happen. So I am actually betting on that. That's what my ZQ position is. And my TLT position, or my long duration position, more and more is about, well, let's just wait till Powell's done at the Fed. Because I know what he's going to do. I say I know what he's going to do. Based on the way he's done everything in the past, nothing about that tells me that for some reason the Fed will be different. That he'll keep his hands off the Fed. You would have thought, well, he'll keep his hands off the Justice Department, right? Wrong. Yeah, but the Department of Defense, right? Wrong. Yeah, but Homeland Security is a different thing, right? Wrong. Every department is a Trump lackey. is a puppet, and he is the puppet master. They will put a puppet in as the head of the Fed, with Trump as the puppet master. They will. And if the Fed, under its current structure, can't deliver what he wants, as Besson said the other day, we will change the way the Fed does things. We will change the structure of the Fed. Period. Right? So that's what I expect. 10 trillion by the end of next year. 8 trillion, or where are we, 6.6? By the end of 2026, that balance sheet will be higher. I don't know where. Higher. If you're going to forecast direction and magnitude, never forecast both, right? He said for Netflix, 1,100 is a price in which you would like to own it. At that price, it has a PE of about 45. How did you arrive to the conclusion that 1,100 is an attractive price at a fair value to own Netflix? Isn't it trading in a much higher multiple than the market? Well, the market doesn't have a strong recurring source of revenue with very little churn, with an annuity in which prices continually increase, with a balance sheet with assets that are listed under their value. Remember, this is a GAAP reporting company, right? So when they do their own internal production of TV shows or whatever the case is, all of that is expensed because it's an internally generated IP, but it doesn't have zero value, right? It doesn't have zero value, but it's expensed. This is why Microsoft was such a great stock in the 90s, they expensed everything. So they had no future amortization against any other revenue. They expensed everything. So you can't just say, well, 45 times. Yeah, but hey, let's look at the quality of that, right? It is a large subscriber base that is fairly loyal overall. You usually, if you have 3 or 4 streaming services, Netflix is usually not the first one to go. If you do have to cut back, it's the other ones that usually go. So you have much lower churn in Netflix than you do in things like Apple TV, Hulu, Prime, all of those others. They have churn rates sometimes as much as 50%. So Netflix doesn't have that. So once you adjust for all of these things that don't show up on the balance sheet, number one, that do have value, especially the large amount that they develop internally, and the loyalty of, I wouldn't say loyalty so much, but the low churn and the price increases over time, you have a growing annuity with a very high occupancy rate, if we want to compare it to like an apartment building or something. So I think it's worth a higher multiple because of that. If you took all of the spending they did, let's normalize it. Let's say they were building a factory and not an IP asset, and normalize it, and say, well, okay, that wouldn't be an expense. A lot of that expense would be capitalized as an asset. You wouldn't be at 45. Now, I'm not a deep diver into Netflix, and diving deep in all of the footnotes and everything. So I'm just sort of giving you a high level perspective here. I can't quote numbers and suddenly start doing adjustments for you. Which is your source for analyst reports on price target downgrades or upgrades? I don't have a source. I get things sent to me. I have access to certain things because of relationships I have, and IB provides me with a steady stream of this stuff. But I don't consider it a source of anything. I don't look at it and say, I need this stuff. I barely read that stuff. With respect to silver gold trade setup, the assumption is that gold only moves by the precious metal component and silver moves by the precious industrial component. Yes, I understand is only a setup and not a trading recommendation. Yeah, well, it is short gold, long silver isolates the industrial component, right? And you do have to adjust for the beta. which requires some kind of regression to do over time. But you can usually trade off the two. And the common element is the US dollar, obviously, and the precious metal component. Now, any trade setup is probabilistic, not deterministic. There is nothing out there that says, if you do this and this, you will absolutely make money. The only thing out there is, if you buy a T-bill, you will absolutely make money. You'll make the risk-free rate. Everything else is probabilistic. That's it. I got 500 shares at 10.85. Oh, this is something else. Everybody knows we're in a bubble. I don't know that everybody knows we're in a bubble. All day long on Bloomberg, you have guests saying, we're not in a bubble. This is not a bubble. We have companies with real earnings, with real this, with real that. We have real assets and real this and real that. Like, I don't know that everyone thinks we're in a bubble. We hear that everywhere now. I agree with the sentiment, but the implications bother me. How is there a bubble if we all know we're in a bubble? Oh, go back to 1999. Everybody knew. And everybody knew that everybody knew. And everybody else knew that everybody else knew. But the market kept going up. You had no choice. You can just sit back and watch it all go past you, or you could just jump in. Right? In the hopes that the bubble inflates some more and we get out of it before it pops. That's usually how you play momentum. Is that even investing, or are we just gambling? At any point in time, a large enough portion of the market is gambling. With retail being as big as it is today, I'd say the market is probably got a significant component of a casino-like atmosphere and behavior to it. Yes. Which just makes the market more volatile. The MP forecast of long-term EBITDA is around 650 million. Long-term EBITDA, including the 140 guaranteed EBITDA for the 10x facility. Largest part of EBITDA forecast associated with the NDP3 floor price. Although there are several assumptions on production targets embedded in those numbers, the overvaluation may not be as extreme as implied by the 20x multiple. Could you comment on this? This looks like it was done from MP. Let's see if we can expand it. And I'll just move this onto the screen. All right, significant EBITDA visibility with upside opportunity. MP is now positioned as a national champion with a durable and scalable economic platform. Illustrative, not forecasted, illustrative. We did this with MicroStrategy. They had one slide which showed just this incredible value creation. And at the very bottom, it says illustrate, for illustrative purposes only. Whenever you present something like this, if you're not going to put the word forecasted EBITDA, you use the word illustrative as, for example, now I have a business called the Applied Level. And I use AWS. We use markmeldrum.com, and AWS is the server. Theoretically, we could handle 1 million subscribers a month. And if I lower the price to $200, I could my estimate for illustrative purposes, let's assume we get 1 million customers a month. That's 200 million a month. That's $2.4 billion a year. At a 10x valuation of sales for a growing company, that's a $24 billion company. For illustrative purposes, mind you. I'm not forecasting that. I'm just saying for illustrative purposes. So this is why you have all of this. Now, I've already adjusted their 6-month EBITDA based this year. And I said, well, what if there was the $110 floor price? We get to zero operating profit. And I think that's why the 110 was chosen, to say, based on your cost structure now, to stop the bleeding, to stop losing money, you'd need at least 110. because they're not going to overpay. You need 110. Okay, here you go. So this is just illustrative. I'm sure if we read, we do have a way to expand here, right? What does it say? Illustrative view of Independence EBITDA, number one, Independence EBITDA, assumes performance under existing supply agreement and companies' estimates of future contracts with potential customers enabled by targeted expansion. My estimate of future contracts with potential customers enabled by targeted expansion. 1 million customers a month for me. That's potential. I have the capacity for it. 1 million customers a month, right? Assuming my existing, and that's my targeted expand. I target this much. Next one, assume 7,000 metric tons of magnet capacity available at 10x annually. Well, they're not going to have that for quite some time. It's not even built. It's not even built. And if you read the contract, it says that they will put a reasonable best effort forward for this. These things are not that easy to build and suddenly be profitable. You don't just build it and everything works out and suddenly you're profitable. You have a long ramp-up period. A long ramp-up period. And they're not the only ones that are going to be selling magnets. They don't get to pick the price at which they're going to sell it at. Everyone's rushing to do this now. All countries everywhere are going to try to get this done. All magnet manufacturing facilities, and there are lots in the world, are going to start scaling up and doing. They have to compete, but assume 7,000 at the 10x facility. Number three for the price floor, assume 6,075 tons of annual NdPr production and targeted run rate production cost. Their targeted cost, their targeted production. And this is not, again, forecasted annual EBITDA. It's illustrative, for illustrative purposes. It is really meant to not fool you, but if you don't ask enough questions, if you don't read it carefully enough, if you don't understand what you're looking at, you might take it for being, holy shit, they're going to do 650 million in EBITDA. No, this is just for illustrative purpose. Like, for example, look what we could possibly do if absolutely everything works out at some point in time based on these assumptions that we're making today. Well, by the time they scale up their facility, how do they know what their production costs are going to be? How do they know what energy costs are going to be? They don't know any of that stuff. It's on them to handle all of those costs. They don't know what their customer supply is. No, they don't know any of this stuff. So if you just want to do something like this, we did this with MicroStrategy. They had a slide showing how absolutely wonderful this whole thing was going to be. And at the very bottom, it said for illustrative purposes only, assuming all securities are converted. Well, if they were all converted, the one thing they missed was the massive dilution in everything that was going to happen. And all of the adjustments they would have to make along the way for all of the, I forget the exact details of it, but it was, in the end, it wasn't a forecast. It was just for illustrative purposes. For example, right? That's all they're saying is for example. Now, if they change that illustrative, they say forecasted. Whoa, that's a big deal. Now you're forecasting something. That's a big deal. So if you want to see how they're going to do, look for their forecasts and their guidance, not these illustrative things that are meant to build a whole bunch of investor excitement. That's all it's meant for. And to safe harbor yourself, you call it illustrative. How are you managing your Netflix position? Did you take a loss on it? No, I'm not going to take a loss on it. I don't have to do that. I sold 1120 puts. And they got put to me. I think my cost is 1114.50. I sold 1060 calls against that, which gets me out at about 1125. So as long as it stays above 1060, I'm good. Because it had fallen past that. By the Friday, it was clear that it was going to be put to me. And since it was below my break-even price, what is the rule? You move your delta towards zero. Thank you. That moves my delta towards zero. So I am long NFLX, and I am short the in-the-money call. And if it stays above this level by November 21st, it will be called away for me. My effective selling price is $11.25. My cost is $11.14. If not, my new price is going to be the $11.14.50 minus, I think I got 65 for this. So minus 65 bucks. That would be my new cost, and then I'll do it again. And again, and again, and again. You said that one of the threats to your ZQ thesis is sudden spike in the Fed funds rate due to liquidity issues, which would put ZQ down and trigger margin calls. I didn't say anything about margin calls, but okay. But why would a short-term spike in federal funds rate affect the one-year future so much? Would it be treated as a temporary dislocation rather than something that should be significantly changed to one-year price? Yeah, I see what you're saying, is that wouldn't it just affect the sort of month that you're in? Because the month you're in, it's the average over the course of that month. But I think it would affect, if you had a spread in 1 month, I think it would change the curve almost in a parallel way. At least sort of what I've seen is that changes are almost parallel. Not exactly, but almost parallel. When you test hypotheticals for ZQ that if we get X rate cuts by the end of October, then ZQ will be Y%. How can you be so sure about Y% given the fact that it could be within a 25 basis point range? Simple. You have, there's the Christmas. Here's the Fed meeting. You're going to have a new chair announced before Christmas, and Bessent is doing the interviews, and Bessent wants a lower Fed funds rate and a 3% 10-year. And he is the gatekeeper, and all the candidates show up, and the ones that get through are the ones that say, yes, sir, yes, sir. Here is May. Meeting, ex-Powell. They have until now, till then, to make sure that that's going to happen. And this first meeting after here, look for 50 to 100 basis point cut. They're not going to do 25. No, let's get it all out of the way right now. We got to get this debt cost lower. We got to fix it right now. Get it lower and start buying those treasuries now. How are you going to get everyone on board? Well, remember, Trump has no line that he's unwilling to cross. No line that he's unwilling to cross. Right? The last thing you want is that envelope delivered to you with a statement of claim in there, because you got to get a lawyer. And I can be pretty sure that the other members of the committee are looking at Lisa Cook and listen, she's not getting away scot-free every month. Those lawyers are bleeding her dry. And it costs Trump nothing. He'll go after somebody else. He'll make an example of somebody else, but he will have that committee. Now you have February, where you don't have to reappoint any president who is not going to, yes sir, yes sir. And all he has to do is control the 7 governors, or the 5 governors, 5 or 7. I think there's 7 and 5. 7 and 5. He just has to control the majority, and he wins. He's going to win. He's going to win. My ZQ may suffer for a while until this person is announced, and this person will say what they're going to do, and then you may get some movement on the curve, but the very first meeting after Powell is done, you're going to get a big cut. Is it the right thing to do? Doesn't matter. It's what's right for Trump, not what's right for you or what's right for anybody else. It's what's right for him. So yeah. Trimble's upcoming earnings report on Wednesday is worth watching, especially following Cat's recent announcement during earnings last week. Okay. What's the MP trade you mentioned at the end? Anyone? I do have that up on Discord if you want to watch that. Given the observable divergence between the relatively stable physical gold inventory on central bank balance sheets, sharply rising valuation of gold as a percentage share of official reserves, it is reasonable to conclude that the majority of the gains bidding of GLD are from speculation. Yeah. Yeah. That central banks are increasing the gold reserves, and which in turn drives the price up. I don't know if it's just that or just the whole idea of, oh my God, fiat, the debt, the this, the that, the US dollar's going to shit. You can't trust anything anymore. That's all it takes to get the retail crowd in. So gold is the new crypto. Gold is the original crypto. And then you had crypto. Now gold is taking its crown back from crypto. So gold is gold. But yeah, is it a gambling? Is it like a gambling token now? 1 ounce of gold is just a gambling token, divisible into grams. You don't need bitcoins and satoshis. You have ounces and grams, right? What are your thoughts on intelligent people working for for-profit companies versus non-profits? Should humanity's smartest people make a lot of money and then donate it? Or dedicate their lives to actually solving society's most difficult problems, or something else? I don't know that I would say any of those things. Sure, I would say, and sure and no. What does it matter? What does it matter what somebody does? What does it matter if I make $1 billion and I'm greedy as hell and I just spend it all on myself? I do have to spend it. And in spending it, I got to buy something from a company, and that company employs people, and those people get a paycheck, and they pay bills. They buy food, they buy clothes, they pay rent, and they pay tax, income tax. And this company pays income tax on what it has left over, and I pay a sales tax. So in buying this $500,000 vehicle, I pay sales tax. The company pays its people, who then pay income tax on their income, who go pay bills, buy food. The store that sells them the food has some net income, pays tax. The place where they buy clothing pays tax. The company pays tax. Look at how much I'm giving society already. Look at how much I'm already donating to society. If you follow it through, I am donating a hell of a lot to society. And I got myself a $500,000 car. Well, here's what sold the car. Well, you had to get the manufacturer of the car. Well, you needed all the raw materials. Well, the mine employs people, and they made money, and there's tax over here, there's tax over here, and you had to get the rubber for the tires, and you had to buy it from Goodyear, and of course they employ people, and they pay tax, and they pay tax. See what I mean? What does it matter? What does it matter what I do? Now, let's say I don't buy that car and I put $500,000 into government bonds. Well, am I not helping the government finance its deficit and finance its spending on social programs? What if I just leave the $500,000 in the bank? There it is. There's $500,000 the bank lends me. Well, the bank lends that out to a small business who then employs people, who then earn income and pay income tax. And if this business is profitable, it pays tax and it earns an interest income. And at the end of the year, that interest income, they pay tax on that as well. Look at all the tax I'm creating no matter what I do. What does it matter? What does it matter what we do? It is all part of the system. The only way that it doesn't help is if I decide to keep it in cash under my pillow. Well, the government has a solution for that. It's called inflation. It says society owes you $500,000 of real goods today. But if you wait 10 years, if you don't participate in the system and you wait 10 years, that only might buy you $300,000 of real goods. So you better participate in the system. So even that, I'm the only one who suffers, because in the future, for the same amount of money, the society only has to give me less stuff back. So what does it matter? And besides, I've in the past donated to charity the tune of $150,000 to $200,000 per year. And the next year you go back and you give another 150 to 200. Next year you go back, you do it again and again and again and again. Every year you go back, you recognize that here's the problem. You're not solving anything. You're feeding the beast. But if I gave a small business $150,000, $200,000 because they had a great business plan and they went to zero, same thing. Here I have a tax deduction because of I gave to a charity, but I don't get 100% of that deduction. Here I get 100% of the loss. I'm in a better after-tax position by losing it in a business venture than I am by giving it to charity. But what if this hits? What if this hits and it employs 50 people who then pay income tax, who then create employment in their community, who then create purchasing power in their community, and then I have a capital gain of which I pay tax on over here? With all the taxes here and all the employment, am I not doing better for society by investing in businesses than giving it to charity? Am I not doing better for society by buying a $250,000 car than investing in a business? Because obviously the dealership has to make money, and the dealership pays taxes, and the dealership pays its employees, and the employees pay tax. And the employee then goes home and pays the rent, and the landlord takes that money and pays tax. Am I not doing the same thing? So live by your own conscience. If you make a lot of money and you feel the need to give back, then do it. If you don't feel the need to give back, then don't do it. Spend it. You will contribute to society just the same. And if you decide I'm not going to spend it, I'm going to hoard it, well, it's going to show up as reserves somewhere in the system. If you buy stock from someone, then they put the money in the bank. It's still reserves. That increases the reserves in the system. It increases the loanable funds available by bank. You're participating in the economy no matter what you do. Is that not good for society as a whole? So I don't think it really matters what you do. It only matters for other people who want to judge you based on the deficits in their life. I don't have what you have, so I don't want you to have it. And if I see you, sailing around in a big yacht and driving fancy cars, I'm going to call you a villain. I'm going to call you a billionaire with that tone, the billionaires. Why? They've resigned themselves to the fact that they'll never have it, so they hate you for having it. You're not spending your money right. And if you try to argue that, hey, don't you work at a shipbuilding yard in which this is where I bought the yacht that you worked on for the last year? Oh, don't bring that up, though. I don't think it matters. I don't think it matters. And if somebody hates you simply because you are far more successful, that says more about how they feel about themselves than how they feel about you. Woo! What do you think of that? Doing DCA since 2 years, currently invested almost 100% in SPY. Starting to shift 50% of my SPY contributions towards IWM, GLD, and XIU for no reason other than a valuation of NVIDIA and Tesla. Do you think this is a prudent decision for long-term horizon? Or should I? Well, I don't know enough about you to know whether it's a prudent decision or not. If you're 66, no. If you're 26, it could be. I would have to know a hell of a lot more. And in the end, I really don't want to be an investment advisor, because the big thing with investment advisors is KYC, know your client, and I know nothing about you. Nothing about you at all, so I can't even begin to tell you whether or not that's a good idea. MP material question. At the time the deal was announced, July, and the stock was around 30. So wouldn't it prefer to be issued at the money and not in the money, given that the conversion price is 30.07? Yeah, the strike was at the money at the time that it was issued. You're correct on that. The warrants for OpenAI were in the money. However, once the deal was announced for MP, it was reasonable, more than reasonable, to assume that the price would have went up immediately, putting those warrants in the money. And beyond that, Warrants are usually issued for a long period of time with a strike price out of the money, usually significantly out of the money. That is the common way to issue warrants. To issue them at the money with 45 days is very suspect. Knowing that any deal announced would have resulted in the pop of the stock, immediately pushing them into being in the money. That's why you have that 45 days there. That's very suspect. It is the deal. It wasn't like, well, it's just some of the terms of the deal. No, it is the deal. It is the deal. So, but you are right on that. If you go back to the date of the announcement, just before they announced the strike price that was set was the closing price. I don't know if it was an average of a number of days or at that day, but it is suspiciously close to that price, yes. I gave you a video notebook LM and asked to debate on this deal as equity analyst criticizing the deal. Investment banker who put this deal together. It is amazing. Well, I won't play it. I'll let somebody else play it, but I'll play it offline. But there it is. Yet another reason to be on Discord, YouTube crowd. If you're not on Discord, you're missing things because I only answer questions on Discord. To join Discord is super easy. Go to markmeldrum.com and register for free. What is there? It is the level 1 content from 2018 because you're not writing the exam. What do you care? It is education in the asset classes, equities, fixed income, derivatives. A way to think about economics is there. FRA, financial statement analysis, some quantitative analysis, quant tools that you will need. I am pushing learning in front of your face for free. And if you're there for free, just click on join Discord and you could be here for free. I'm not trying to sell you anything. I'm trying to force you into education. That's all I'm trying to do. So sue me. Anyways, that'll take care of it for this week.